Thanks for tuning into the Portfolio Manager. Here's a show where we try and talk to a portfolio manager about how she or he thinks of the portfolio construct in order to generate alpha over the course of the next 12 to 24 to 36 months. It could be a 1 year to a 3 year view that the portfolio manager may bring to the table. Our guest today is Mr. Ramesh Mantri of WhiteOak Capital, and we're going to be talking to him about one of the benchmark schemes that he's been leading since inception at WhiteOak, which is the Flexi Cap Fund. And Ramesh, thanks so much for joining on the show. And it's the first time we're having you in a studio, so welcome.
Thank you, Niraj. Thank you for hosting.
The pleasure is entirely ours. So the idea of taking the Flexi Cap amongst many other things, Ramesh, because it gives me a chance to ask you about the whole gamut of market cap, right? So how are you approaching the portfolio construct at this point of time wherein we've seen a bit of a rally for the markets and the year is filled with a number of uncertainties, including FOMC decision and the election results globally?
Yeah, so first I would say the world is always uncertain. So I wouldn't never give the confidence that there is no uncertainty. The uncertainty is the degree changes. And by the way, expected uncertainties don't impact the market. You know, it is unexpected events that really move the market. So I would say election is now a less of an unexpected event. And so, and Federal Reserve has been around for a long time. So it's always Federal Reserve actions will happen. So I don't think these are big deals. I think what has happened in India, you know, post the COVID is the economy has seen broad-based momentum. You know, earlier a few sectors were doing well. You know, in fact, the economy was quite weak going into COVID. You know, the only sectors like IT, pharma, consumer were doing well. Now I would say a few engines were running and now the whole economy is doing well, whether it is cyclicals like capital goods, metals, commodities, infra, real estate, tremendous, you know, economic momentum in real estate. So it's a broad-based recovery. And that's why the set of opportunities have expanded in the market. And of course, after a long period, after 17, a lot of companies got opportunity to go public, right? So companies and entrepreneurs are raising capital. So we've seen a huge amount of companies go public in the last 3 years. So that expands the opportunity set. And you know, every $1 trillion of GDP you need to create new companies, new business models, you know, new industries. So if that cycle of new companies stop coming into the market loses their economic vibrancy.
Sure.
You know, so you know, I'll just give an example. Something like electronics manufacturing is something that has happened in the last 5 years. A number of companies have gone public. You didn't have scale electronics manufacturing companies going public. So for example, now you have started seeing interesting consumer tech companies also started going public. Many of them were loss-making, but they made very interesting pivots, many of them, and some of them very successful pivots to profitable business models. So you need constant churn, new companies to come into the market. Like for example, healthcare services sector, hardly a few companies listed a few years ago, and now you have a large number of, you know, healthcare companies available. So the opportunity set has become a lot more interesting. It's a better market to be an active manager.
Better market for an active manager, great. So, okay, so in light of that, I'm again looking at one particular aspect of your AMC, which is the Flexi Cap Fund, as we said at the start. I see a very interesting allocation thus far. This is as of Feb end, I believe. But despite having the choice to be different, you still have about 40% or slightly over that in the mid space and 28% in the small cap space at a point of time when everybody's crying hoarse about the valuations in the small cap universe. So you clearly believe in this thing about emerging themes, which will likely become larger over a period of time, and you're putting your money where your mouth is.
Yes, so one, I think clearly valuation, the ask rate in small caps is higher today than it has been for last 3-4 years now. So I wouldn't say there's not a challenge in small cap space. At the same time, for an AMC, which is extremely well resourced on research, you know, for us, you know, small cap, by the way, small cap, mid cap is a higher alpha pool for everyone. If you have a lot of your own research, then you have a lot more ability to generate alpha. So it is like our ability, our confidence in our team's ability to generate alpha, even when valuations today are less attractive in the small cap space than they have been. And there is also constant churn happening in the small cap with new companies coming into the markets, new IPOs and all. So, and I would say the new emerging India, you participate actually through small and mid caps. only when companies become large and mature, they transition into large cap. So a lot of those, emerging themes in India, whether you talk about, growth in, defense, capex, or for the matter, electronics manufacturing, healthcare services, number of sectors that have been doing exceedingly well, they typically tend to be in small and mid cap.
So would it be safe to assume that your view, I'm paraphrasing or maybe I'm putting words in your mouth, but would it be fair to assume that you believe that even if the SMID space were to go sideways or even correct, but there will be bottom-up opportunities wherein earnings growth, etc., is in favor, which might do well independent of what the indices do?
Yes. So, in small cap and mid cap space, managers portfolios can behave very differently from the benchmarks because it's a very bottom driven, risk investment. Macro themes matter less and micro themes like what the individual company does matters a lot. So clearly a lot of confidence that, we can do substantially different. In fact, a very strong small cap and mid cap rally, which we have seen in the last 12 months, is actually difficult for active managers because in a very strong market rally, highest risk taking gets rewarded, not balanced risk taking. But as market transition and volatility now emerges and has emerged clearly in the last few days, you'll start seeing very clearly that active managers start doing well.
Okay. Well, looking forward to doing this show 1 year from now to try and assess that as well. But no, I mean, it's great for times like these to happen because then the wheat gets separated from the chaff, right? Otherwise, everybody's painted with the same brush. So I'll talk about multiple themes as well. But are there, Ramesh, any risks as a portfolio manager who's looking at multiple portfolios, Flexi Cap and others by virtue of what you do, direct or indirectly, that you do oversee at WhiteOak? What, to your mind, is the biggest risk? And I know you said that the known risks will not impact, the unknowns will. But I'm still tempted to ask you, what worries you the most?
Yes, so one, the valuations in the smaller the market cap, when you can start from SME, then micro cap, then small cap, the valuation curve is reverse. Today the mega caps are the most attractive, then large caps, then mid cap, and then you can go down the market cap. Keep getting worse. So the quality clearly, and secondly, markets have not in the last 12 months differentiated between quality businesses and poor quality businesses and managements. So enough capital has been made available to even poor quality companies and management. So, and by the way, supply also keeps turning up because a lot of companies are constantly raising. You have practically in capital raising every day today, apart from IPOs. I'm talking of either a large, big investor exit or companies raising primary money. So I think the supply is really the issue. The quality of supply, that is really the issue.
I'm trying to look at the pockets that you bet on and where is it that you are overweight, underweight, maybe relative to the sector, but independent of the weightages as well. Would love to understand what is it that you believe had the highest chance of generating alpha over the next 12 to 24 months?
So if you ask me where does the value lie in markets, where fundamentals are good and value and prices are right, I think clearly BFSI sector is where, the fundamentals are still very good. You're still not seeing a credit cycle, which is what damages BFSI on the lending side. So that part of the market, I think valuations are actually below average, particularly for very high quality financials. So that's really, I would say on a 3-year basis, that is really the pocket that looks very attractive to us. Then the other reasonably large sector where valuations are very normal and fundamentals continue to improve is pharma sector. This again, that sector did well during COVID and then went out of favor. Again, fundamentals have improved both on US generic, and clearly there's a very large opportunity on the CDMO CRO side, which is I would say the another Indian version of the IT industry. There's a large potential there, and of course, even on healthcare, while some regulatory challenges have emerged on healthcare, the opportunity in medical tourism still remains very large, and again, this sector again has seen a lot of discipline. So these are the two real sectors where valuations are reasonable or attractive, and fundamentals remain good. Unfortunately, a number of other sectors either are seeing much above average valuations or too much just poor quality of companies and just too much stretch valuations. So I'm slightly cautious about them, but otherwise these are the real two pockets for me on a sector basis.
So banks have been showing value for a while now,
Yeah.
right? But the movement isn't happening.
Yes.
Was it a supply side issue and in the foreigners selling which was leading this? And do you think that is the reason which will change, which is making you so constructive? Because fundamentals have been good now for a while.
Yes, so let's understand this. A large part of FI selling, in the last 2 years in India have happened in financials. That number is 60 to 70% of the selling that's happening. So they've gone from significant overweight and they've cut that position. And it is very difficult for domestic capital to absorb that kind of selling. And by the way, market also become much broader. Today there are opportunities in all sectors, so people don't have to allocate only to financials. And number two, particularly on a couple of large banks, you've seen management transitions. In the sense, and one in a management transition, one in a merger. And of course, we are going through a very difficult liquidity cycle. There's a massive fight for deposits, which is causing a lot of pain in the banking side, on the cost of the funding side. But I would believe these are intermediate challenges. And as the liquidity situation improves, the biggest risk in banking is always a credit cycle. And we don't see any signs of a credit cycle. Yes, there are pockets in below 50,000 loans, very narrow pockets where generally banks don't participate. We have seen some spikes in credit quality, poor quality. But otherwise, there is no signs of a credit cycle as yet. So banking typically struggles when there's a credit cycle. Deposits, eventually, they will figure out to price it to the customers.
Got it. And you clearly betting on the private bankers, because I see the weightages. I'm not asking you to comment on stocks, of course, but I'm just laying it out that ICICI, HDFC banks right up there, not too many PSU banks. So you're betting on the private banks doing better than the PSU banks?
Yes. So one, the valuation differential between private banks and PSU banks have not narrowed significantly. When you adjust for the quality of franchises, we do own public PSU banks.
Yeah, you do.
Within the pack. But I would say clearly, when you look at very long-term, even long-term averages, clearly today private banks are more attractive than PSU even on a relative basis.
Fair call. The other aspect I heard you mention about CDMO, CRO being an opportunity. Healthcare presence about 5% in the portfolio. Is that an overweight stance or is it an equal weight stance? Part one of my question. Part two of my question. These are, in some sense, also slightly longer gestation businesses in that returns are maybe lopsided, back-ended relative to the investments. You think, and companies have been around for a while now, they're making some of these investments. You think the returns are now closer than what they were earlier?
Yeah, so, if the businesses are short gazettation, right, then actually you can see a lot of competition. Because if someone starts doing well, other people will jump in. If a business is a very long gazettation business, just think of another very different example of life insurance, right? Then it becomes very difficult. The pot of gold is much later in the cycle. So actually it creates large entry barriers, the fact that the business is a long gazettation, and the terrain is in favor of the incumbents. It's like people who are there, it favors them. So competition becomes harder actually over longer term. The competitive space is much simpler if it's a longer term gazettation period. Number two, the same, if you're talking of CDMO, CRO, CDMO, the same capabilities that India has in IT, which is basically one highly qualified talent, which is in, chemical engineers, BSc chemistry versus tech engineers, low cost, highly talented. And number two, the fact that India has a great reputation for, history of protection of IP, that's why the IT industry is scaled up. Those two dimensions remain. And number three is, I think the US, pharma companies are under significant pressure to cut costs because the cost of drug discovery is going up a lot. So India is, and number three, because of the geopolitics today, even on this industry, India is better positioned today than it was. So over longer term, but it's a harder industry. It's also, if it's harder, it also means competition is going to be less. Coming to healthcare, we are clearly overweight there. I like to say is that, among all the industries you can think of, healthcare is probably one of the most non-discretionary spending. In fact, I would say when you're sick, you don't even like eating food.
Yeah.
So medicine is comes ahead of food, So it's a sector with very low, longer term, correlation with markets. Long-term returns are very good. And it's a sector which requires very specialized knowledge. So if you can do bottom-up research, you can add a lot more alpha in pharma and healthcare. So that's the reason. We're overweight not because we think the sector will do very well. It's simply we have a lot more confidence in our ability to generate alpha in that sector.
Okay, and it's concentrated towards CDMO, CRO as opposed to US generics, etc.
Yeah,
I mean, just the relative weightages.
So we are participating in nearly all pockets, but I would say it is more balanced towards this bucket, then domestic branded generics, and also healthcare in India.
Okay, so other than pharma, the healthcare services?
Yes, healthcare services.
Okay, got it. I mean, diagnostics, hospitals, what have you?
Yes.
Okay, fair call. I heard you speak about real estate.
Yeah.
A sector that has enjoyed great reputation in the past, great weightages in the past until 2008.
Yeah.
People who've been around that long would remember this. The weightages have come off quite materially.
Yes.
Is it right to think of maybe the possibility of weightages going back to those levels, because almost everyone believes they're in the midst of a long-term upcycle? How are you thinking about real estate investing?
Yeah, one, if you look at globally, while real estate happens to be the largest industry in just about every country, yet very rarely you see very large index weights in real estate stocks. There are two reasons for this. One, it's a sector that tends to fragment. It's a fairly fragmented. Real estate tends to be very local. Often, the Delhi developers don't do well in Bombay, and the Bombay developers don't do well in Delhi. So even in US, it's a very localized business. So it's a very local dimension. So you can't scale profitably. People do try to go to other markets, and when they become very ambitious, but actually success stories are far. And people believe in an upcycle that will go everywhere and will sell. And actually, real estate being highly cyclical, in the upcycle, anyone can set up a project and sell. But then invariably the cycle turns down. You've seen a lot of euphoria in the last two odd years now in both volumes and prices. Prices more in select markets, volume across the country. So I believe markets where pricing has been stayed reasonable and price hikes have not been, I think the market will stay firm and continue to absorb. One of the things we are hearing from a lot of developers is this time the demand is more on users rather than investors. So that makes the market more sustainable. Of course, there'll be parts of the market in real estate India, particularly in NCR and all, which will have a lot more investor demand. But particularly southern India is more user driven. Generally the construct of the market, and generally you don't see very large spikes in Bangalore, Hyderabad, all these markets. They tend to be less speculative markets. So we like markets which are less speculative. Prices are reasonable, and secondly, clearly there is a shift in markets where people are less confident of buying under construction property and buying delivered property. And the market has consolidated in favor of large brands, trusted brands. But I'll tell you again, there'll be a cycle of this consolidation. So again, new players are jumping in. Real estate is always that cyclical. Everybody jumps in the upcycle. So it'll play out in a few years the same way. But I would say there are players who have been there in the last cycle and survived and done reasonably okay. You have to look at them because they have a DNA of prospering across cycle and not just being, flash in the pan.
And you playing this via real estate developers mainly, or are ancillaries also a big part here?
So you participate both ways. There are you invest through real estate developers. There is another asset class that's been created in the last 5-7 years called REIT. But REIT has a very different dimension because there's no development element there generally. So that is another way. But you also participate through mortgage financiers, through the whole ecosystem of building materials. So you participate across the board.
Got it. You should have known I won't end the show without talking about IT services, right? Because you guys have you have some brilliant thoughts there. I would love to understand. You have a weightage there, 10-11% out there. Is this market weight? Is it overweight, equal weight? Part one. And why is it that you have this 11% exposure to IT?
No, one, we are more or less sort of more or less neutral to the market, but when you look at the portfolio construct, it is significantly overweight small and mid versus large. So the mid cap index tends to be very skewed towards large caps, while our portfolio has a very large skew towards small and mid caps. One of our, something that we believe for 7 years in India is that the small and mid caps will do well in IT, and they've done well. And there are a number of reasons. On your show, I've talked about earlier why mid cap and small cap will do well. I'm particularly invested in a very interesting space now in IT services, which we generally don't talk much about in India. It's called the enterprise software space. So India has largely been IT services to Western world, to Americas and Europe. That's typically the IT services model. And whatever we say, AI is an emerging disruption. And the pace at which things are changing, you can be sure what happens in a year, but it's very hard to predict what happens even on a 3-year basis. So let's be very clear, the space is fast evolving. So I'm an optimist, but I would be cautious optimistic that things may be a lot more difficult in the middle for IT services, large companies. Why I like enterprise software? Because earlier it was always used to be the Western world. Now we have created a number of enterprise software companies in India, which are catering to the Indian market, but also doing exceedingly well in emerging market, particularly Middle East. And Middle East is doing very well. So for example, you have a number of banking software companies in India, and now there are a number of them in public markets in India. And they are focused on the capex which the private and the PSU banks are doing, the Middle East banks are doing, emerging markets banks are doing. And they are doing very well, growing well. Margins are very fantastic. They are not subject to a lot of these disruptions and the cyclicality of the Western economies. And valuations are very reasonable there. And normally, if you look at the best tech companies in the world, think of Microsoft. Microsoft is an enterprise tech company. So ultimately, the highest valuations go to enterprise tech companies in the world.
You're betting on that. Okay. Wow. Well, we can go on, but unfortunately, television compulsions, the show has to end because the time is up. But lovely understanding this brief bit from you, Ramesh, and look forward to have you more often where we can pick your brains around what the portfolio construction is and why so.
Sure. Thank you. Thanks a lot.
Now, this was a pleasure. Thank you for joining in today. And viewers, thanks for tuning into the yet another episode of The Portfolio Manager.